Assalamu alaikum. Today's topic is double entry system. To understand double entry system, first we need to understand basic six elements of the accounts. By nature, we can divide all accounting transactions into six elements. Number one, assets. I will explain later. Number two, number three, capital. Number four, income. Number five, expenses. Number six, drawings. Now we discuss one by one in detail. Assets are resources of the business. For further detail, theoretical notes are available. But here, to understand double entry system, I will explain which is needed for the topic. Assets are resources of the business. These are further divided into two parts: non-current assets and current assets. Non-current assets are those assets which we are using in the business for more than 1 year. These are assets which are used in the business for more than 1 year. We are getting economic benefit for more than 1 year, and current assets are day to day running business. Working capital. Now, non-current assets are further divided into two parts: tangible and intangible. Tangible assets are those we can touch, like land, building, machinery, plants, office furniture, office equipment, and which we cannot touch. The good reputation of the business, its trademark or license, I explain again. Resources of the business are non-current assets and current assets. Non-current assets are which we are using for more than 1 year. Current assets are we are using on the daily basis, like cash in hand, which is in the office. Cash at a bank is also the current asset, and stock of goods, stock of goods which are available for resale, also known as inventory of goods, and amounts receivable called trade receivables. Trade receivables are those amounts which are receivable from the customers. We sold some goods or services and they promise to pay money in the later period. These amounts are receivable. So current assets are cash in hand, cash at bank, stock of goods, and trade receivables. Hope you have got the assets. Assets are resources of the business, non-current assets, current assets, non-current assets for more than 1 year, tangible, intangible. Tangible assets are land, building, machinery, plants, office furniture, office equipment. And current assets are which we are using on the daily basis, which are changing on the daily basis, which are for the working capital requirement of the business, like cash in hand, cash at bank, stock of goods, trade receivables. These are already cash or these can be easily converted into the cash. But non-current assets cannot be easily converted into cash. It may be taking some time to convert into the cash. So non-current assets are not liquid assets, but current assets are your liquid assets. Second is liabilities. Liabilities are all payable amounts, all payable amounts these can be further divided into two parts: non-current liabilities and current liabilities. Non-current liabilities are those liabilities which are payable for more than 1 year. These are not urgently due. These are payable. We have time for the payment for more than 1 year, like bank loan, repayable, after 3 years or 5 years, and current liabilities are those liabilities which are payable within a year, which are due within a year, like trade payables less than 1 year. For example, we purchase some goods, we bought any machinery or furniture or office equipment, and we promise to pay within a year, like 3 months, 2 months, 5 months, 6 months. So these liabilities are current liabilities. These amounts are payable, but these amounts are due within a year in the near future. And some other amounts are outstanding bills like electricity bills or utility bills. Sometimes salaries are payable. Other synonyms are accruals or creditors. All word mean these are current liabilities. Owing, due, or any type of arrears which are payables. Mean we have taken services or we have purchased goods, but the money is payable within a year, so that liability is current liability. I will explain again. Liabilities are all amounts payable. If these amounts are payable within a year, so these are called current liabilities. But if the amounts are payable more than 1 year, we have time for the payments. So these are called non-current liabilities, like bank loan, which is repayable after 3 years or 4 years or 5 years. And current liabilities are payable amounts which are due within a year, like 3 months, 4 months, 8 months, 10 months. Like trade payables are those payables we purchase some goods and we promise to pay in the later period. So these amounts are due. Sometime electricity bill is due, sometimes salaries are due, outstanding, arrears, accrued, outstanding payables, all having the same meaning. The main difference between current liabilities and non-current liabilities is the time period. If loan is due within a year, so then that amount will be considered as the current liability. Sometimes we repay loan in installments, so the current year installment is the current liability and the rest will be the long term liability. Third content is capital, which is very important. The owner's equity. Capital is the owner's equity. Capital is also called owner's equity. Owner's equity mean owner's share in the business. Owner's share in the business. Owner is investing in the business and taking risk of profit or loss. Whenever owner is investing in the business, he or she is taking risk of profit or loss. Taking risk of profit or loss. Following things may affect the capital. If further investment, capital will be increased. If there is further investment, so capital will be increased. After 1 year, if there is an income, it will increase the capital. If there is loss, it will decrease the capital. Loss or expenses, these will decrease the capital. And if owner withdrew some goods or cash from the business, withdrew money from the business for personal or private uses called drawings, so drawings will decrease the capital. We will further practice these things in the later chapters. Next content is incomes, income or revenue. Income or revenue is any activity which leads to increase in the net assets of the business following are the examples of incomes like sale of goods, or sales or revenue. Sometime commission is earned or commission received. Sometime we deposit money into the bank and then we receive interest. That is also income for the business. Sometime we sell any asset on profit. This is also income of the business. We rent out buildings and receive rent, that is rental income. And there may be some other types of incomes, but whenever income is earned, we are receiving money. Next is expenses. Expense mean any activity which leads to decrease in net assets of the business For example, cost of purchase of goods and salary expenses, marketing expenses, electricity expense. I am giving few examples of expenses. Next is drawings. Drawings are goods or services or cash taken by the owner for his personal use, or we can say his private expenses. Whenever owner is investing in the business, so capital is increased. But when the owner is withdrawing from the business, cash or goods or machinery or any servers, so that is called drawings. It's opposite of the capital. These are the six main contents: assets, liabilities, capital, income, expense, and drawings. Now we discuss how we use these in the accounting. In the double entry system, there are two sides of an account whenever we are recording transactions in the business. So, in the account, there are two sides of an account, like left side is called debit record and right side is called credit record. In accounting, there are two sides to record the information, to record the data, to record the accounting transactions. One is called debit record, one side is called debit record, shortcut is DR. DR here not stand for doctor, DR stand for debit record. And the credit side is called CR. This is an accounting system. This is a double entry system. Whatever we are writing on the debit side, with the same amount, we must have to write something on the credit side. It will be balanced. Like both sides, the sum of debits and sum of credits will be balanced every time. This is the double entry accounting system. First of all, I give you example. We are starting business with cash of we are starting business with cash of 500,000. On one side, we can see that cash is the asset. On other side is the equity side. Here we can say capital. So you can see both sides are equal. When we are investing in the business, we started business. On one side, on debit side, there is 500,000. On credit side, there is 500,000. So this is balanced. Then we took some cash from bank as a loan. So cash at bank is increased. For instance, we are taking loan of 200,000. So cash at bank will be 200,000, but this is the loan. This is the loan from bank. This is loan from bank. This is liability. This is liability. So again, you can see on one side assets are 500 and 200, 700,000. And what is the explanation of these 700,000? 500,000 is the capital which is invested by the owner, and 200,000 is the liability which is payable to the outsiders, to the bank. So total is equal to the 700,000. This is called accounting equation or accounting balance sheet. This is called accounting equation or accounting balance sheet. Whenever we are recording transactions, we have to keep balance of assets equal to liabilities plus capital. Here we can see assets are 700,000, liabilities are 200,000, and capital is 500,000. This is called accounting equation and also known as balance sheet. So the assets will always be equal to liabilities and capital. This is only possible if we are following the rules of double entry system. We are following the rules of debit and credit. Now we discuss how can we record transactions in the accounts in the double entry system. Rules of debit and credit. rules of debit and credit. Again, we will be writing the six content which we discussed earlier. Assets, liabilities, capital, income, expense, drawings. These are the main six contents which we have already discussed. Now we write the rules of debit and credit here. These are international golden rules of debit and credit, like assets we normally write on the debit side. Normally assets are written on the debit side, and liabilities in normal situation we write on the credit side. Capital is written on the credit side. Income, because added into the capital, so that's why it will be written on the credit side. Expenses, because decrease the capital, that's why write on the debit side. Drawings also decrease the capital, that's why we write on the debit side. This is normal situation. In the normal situation, but if these are increasing or decreasing, then what will happen? If assets are increasing, then remain on the same side. Debit remain on the debit side. Credit remain on the credit side. If assets, liability, capital, income, expense, drawings normally are on the debit, credit, 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 debit, debit, then if assets are increasing, we write on the debit side on the same side. Liabilities are increasing, we write on the same side. Capital increasing, we write on the same side, like credit side. Income increasing, we write on the same side. Expense is increasing, we write on the same side, like debit side. But if these are decreasing, then we write on the opposite side. If assets are decreasing, we write on the credit side. Normally, assets are written on the debit side. If increasing, on the same side. If decreasing, then we write on the credit side, on the opposite side. Liabilities we normally write on the credit side. If increasing, we write on the same side. If decreasing, then we write on the credit side. Then we write on the opposite side, on the debit side. Capital normally written on the credit side. If increasing, we write on the credit side. If decreasing, then we write on the opposite side, on the debit side. Incomes normally written on the credit side. If increasing, we write on the credit side. If decreasing, then we write on the opposite side. Expenses normally we write on the debit side. If increasing, we write on the same side, on the debit side. If decreasing, then we write on the opposite side, on the credit side. Drawings normally we write on the debit side. If increasing, we write on the same side. If decreasing, then we write on the opposite side, on the credit side. These are the rules of debit and credit which we have to memorize, and then we can use these rules for recording the transactions. Okay, what is the transaction? Is give and take, given and taken, like exchange of goods and services is called transactions. For example, bought a machine dollar 5,000. So here is exchange of machine and cash. So this transaction, this is called a transaction, a situation. Now, how we record this transaction, how we record this into the accounting, into the accounts. First of all, we see which accounts will be used, which accounts will be used. So here two accounts are getting involved, machine and cash. Then we check what is the nature of these accounts. What is the nature of these accounts? Machine is your asset, cash is also your asset. Then we analyze. In this transaction, when we are buying a machine, machine is increasing, machine asset is increasing in the business, and another cash asset we are paying, so this cash asset is decreasing. So on the basis of analysis, now we will apply rules of debit and credit. Now we will apply rules of debit or credit. As we know, when assets are increasing, we write on the debit side, and when assets are decreasing, we write on the credit side. Now, what is the meaning of this analysis? This means when we are preparing a journal, in the general journal, this is the first book in which transactions are recorded. This is called general journal. Its structure is like this. Here we write date, here detail of the transactions, here debit record and credit record. So this is the first transaction, so date first we can put in this transaction. First of all, we write which are debit entries. So in first transaction, machine asset is increasing. So machine account, AC stand for machine account debit. First we write debit amount. Machine account will be debited by 5,000 and cash account will be credited by 5,000. And here we give explanation to record machine bought for cash, like we are purchasing machine and making payment. This one transaction is completed in the first book, which is called general journal, and next book is called general ledger. Next is general ledger. Same transaction, you can see 5,000 is written on the debit side and 5,000 is written on the credit side. Same transaction we have to show in the general ledger. Here two T accounts will be prepared. Machine account, this is called T account. This also consisting of two sides, debit and credit. Machine account and cash account. Here again we can apply the same rules. Machine account is an asset which is increasing. That's why we are writing on the debit side. This is the debit side. And cash account is another asset which is decreasing from the business. That's why we are writing on the credit side 5,000. And we give opposite explanation. In machine account, we write cash account, and in cash account, we give explanation of machine account. This is the first transaction. I have passed only one transaction in this. For further understanding, we can write another transaction. Okay, for example, if I say we took loan from bank, cash $2,000. So how can we process this transaction? Again, we will follow the same steps. Which accounts are involved in this transaction? What is the nature of these accounts? what is the analysis, and then we will apply the rules of debit and credit. Accounts in these transactions are cash, one is cash account, another is bank loan, another is bank loan. Now, what is the nature of these two accounts? Cash account is your asset, as I have explained earlier. Bank loan is your liability. Bank loan is liability. When we are receiving cash, so cash asset is increasing in the business. At the same time, liability is also increasing. Whenever we are taking loan, so our liability is increasing. When assets are increasing, when assets are increasing, we write on the debit side. So we will be writing 2000 on the debit side, and on the other hand, liability is increasing. When liability increase, we write on the credit side same amount of 2000. Now we can pass this transaction in the T counts. As you know, we have cash account already there, so we can write in the cash account 2000 on the debit side, and another account we need to prepare is only loan from bank, and here liability is increasing, so we will write on the credit side. We give opposite explanation. In the bank account we write cash, and in the cash account we will write loan. If we pass the same second entry in the general, so we can pass this transaction. Now we are taking cash, so cash account debit 2000, and loan from bank credit by 2000. The explanation will be to record loan from bank. That's it. In the same way, we process all the transactions. So till now we have done assets, liabilities, capital, expenses, drawings in detail. Then we discussed rules of debit and credit. Rules of debit and credit are assets, liabilities, capital, income, expense, drawings. Normally we write on the debit side. If increasing assets, we write on the same side. If decreasing, we write on the opposite side, on the credit side. And you need to learn these rules of debit and credit. Then these are the transactions. transactions are given and taken when we are giving something or receiving something, like bought a machine of $5,000. So here first of all we process. This process is needed for passing the journal entry for recording the business transactions. First we check which accounts are used, like machine and cash. Then we check what is the nature of machine, if this is asset, liability, capital, income, expense or drawings. Then we check what is the analysis. So in this transaction, machine asset is increasing. That's why we are writing on the debit side 5,000. And cash asset is decreasing, and we write on the credit side 5,000. The same transaction, once we have processed, we record into the first day book of general journal. First accounting book is called general journal. You can see machine account is debited 5,000 in the debit column, cash account 5,000 on the credit column. Same transaction we recorded in the accounts. Machine account 5,000 debit side, cash account 5,000 credit side. Then we pass second transaction. We took loan from bank, cash 2,000. So here again we processed cash asset increasing. We are writing on the debit side. Bank loan, which is liability, increasing. We write on the credit side 2,000. So cash account 2,000 on the debit side, you can see, and loan from bank 2,000 is written on the credit side. For passing all these transactions into the accounts, here you can see if we write 2 transactions, 3 transactions, 4 transactions, 20 transactions or 100 transactions or 1000 transactions, sum of debit must equal to the sum of credits. Here you can check the sum of debit is equal to the sum of credits. Each page is total 5,000, 2,000, 7,000 and 5,000 and 2,000, 7,000. That's why this is called double entry system. Whatever transactions we are writing on the debit side, same amount we are writing on the credit side. Sum of debit equal to the sum of credit. Sum of left side equal to the sum of right side. In the T counts, if we see 5,000 and 2,000, 7,000, and same you can see 5,000 and 2,000, again the sum is equal. For further practice, next step is we will cover in the next class, in which complete process of double entry system will be explained. Like, first of all, there are transactions. Through transactions, some business documents are prepared. Some business documents are prepared, we will discuss in detail. And those business documents are recorded into the journals, and from journals these are transferred to the ledgers, and from ledgers trial balance is prepared. What are all these? We will be discussing in the next class. And from trial balance, companies prepare income statements. Through income statements, they prepare balance sheet. Latest name of balance sheet is statement of financial position. statement of financial position. You all are not familiar with these terms. We will be discussing later in detail, and also they prepare cash flow statements. Then auditors reports, also called steward stewardship report, directors reports,